Okay, so I know the last few weeks have felt like a lot of noise. Bitcoin bouncing around the 60s and the $70,000 range. The Clarity Act still working its way through Congress. Everyone waiting for some kind of signal regarding what happens next. And honestly, I think that's exactly the right moment to zoom out. Because while the market has been in this kind of holding pattern, uncertain, range-bound waiting, some of the biggest financial institutions on the planet have been using this time to make moves that most people completely miss. And it can foreshadow what we can expect to happen soon. So today, instead of reacting to prices, I want to be forward-looking. I want to show you what the whales, and I mean real institutional whales, not just Twitter whales, okay? What they have actually been doing while everyone else has been paralyzed by uncertainty and fear. Because here's what happened just this past week. BlackRock, the largest asset manager on earth, okay? The firm that manages $14 trillion, bought governance tokens for a decentralized exchange. Apollo Global, the largest credit manager in the world, nearly $1 trillion in assets under management, signed a deal to become a major token holder in a DeFi lending protocol. And Grayscale filed with the SEC for something that has never existed before in the United States. The first ever DeFi token ETF. And all of this happened in 5 days. While the price chart looked sideways and scary, mind you, that's not a coincidence. That's how institutions accumulate, quietly, deliberately, and while everyone else is distracted and scared. So today, we're going to slow down and actually understand what they're building towards. Because this is not a price story. This is a systems story. And those are the ones that actually change everything. All right, before we get into the specific moves, I need to make sure we're on the same page about what DeFi actually is. Because decentralized finance is one of those terms that gets thrown around constantly and almost never gets explained properly. So here's the simple version. Traditional finance runs on centralized systems. When you take out a loan, for instance, a bank decides whether to give it to you. When you trade a stock, an exchange matches your order. When you send money internationally, a network of correspondent banks routes it. Everything runs through a middleman. And that middleman charges fees, sets rules, and can shut you out whenever they want. So DeFi replaces those middlemen with software, specifically with smart contracts running on public blockchains. Lending, borrowing, trading, earning yield, all of it happens automatically, transparently, without a central operator who can freeze your account or change the terms on you on a whim. Now, here is where it gets interesting. When Wall Street first started paying attention to crypto, they were buying Bitcoin. And the pitch for Bitcoin is basically it's digital gold. It stores value, it's scarce. That's a relatively easy concept for a traditional asset manager to underwrite. But what happened this week is different. BlackRock, Apollo, and Grayscale aren't just buying exposure to crypto prices. They're buying into the infrastructure itself. They're acquiring stakes in the protocols that run the rails. Now, here's an analogy for you to help bring this to life. There's a difference between buying shares in a railroad company and buying the actual tracks, right? One gives you upside if the company performs well, while the other gives you stake in every single thing that moves on those tracks forever. It's like during the gold rush. There were those seeking gold, right? And those that just sold the shovels. And apparently, historically, more often than not, those that sold the shovels became exponentially more wealthy than those that were just hunting only for gold. And that's the shift that happened this week. And most people completely missed it because the media isn't promoting it. So let's start with BlackRock, because this one honestly stopped me in my tracks when I read it. On February 11th, BlackRock did something that would have been considered absolutely unthinkable even 2 years ago. They took their tokenized US Treasury fund, a product called Build, and they put it on Uniswap. Now, if you don't know what Uniswap is, it's the largest decentralized exchange in crypto. There's no CEO, there's no headquarters, there's no customer service number. It's just code running on Ethereum's blockchain, automatically matching trades between users 24 hours a day, 7 days a week. And it processes billions of dollars in trading volume. And BlackRock, the firm that manages the retirement savings of millions of Americans, just listed one of their financial products on it. But that is not even the most surprising part. BlackRock also bought Uni tokens directly, not through some fund or derivative or indirect vehicle. They bought the actual governance tokens for Uniswap. And here's why that matters. Uni, the token, isn't just a speculative asset. Uni is a governance token. Holding Uni means you have voting rights over how Uniswap operates. Things like trading fee parameters, which assets get supported, and how the protocol upgrades over time. So think about what just happened. The largest asset manager on the planet, a firm that has a seat at the table with every major central bank, every sovereign wealth fund, every pension system globally, and may actually, this is not cited anywhere, have a vote and a voice behind every major government in the world, or many of them actually. This entity, went out and bought voting rights in a decentralized exchange. Tell me yes or no, the future has not arrived. And to let this sink in a bit more, imagine Goldman Sachs buying voting shares in the New York Stock Exchange, not just trading on it, not just listing their products on it, actually acquiring a governance stake in the exchange itself. That's the structural equivalent of what BlackRock just did. And the reason this matters isn't just symbolic, it's about direction of travel. When a $14 trillion asset manager makes a strategic move like this, as it was, they're not doing it on a whim. They're doing it because they believe that Uniswap and decentralized exchanges generally are going to be a critical piece of financial infrastructure they want to have influence over. And that's also why, just a quick note on the Clarity Act, that's also why I believe ultimately banks are going to strike some sort of partnership with crypto exchanges in America, such as Coinbase, potentially Gemini, although that has not been announced anywhere. This is just me speaking off the top of my head based off of things I understand, okay? Because it's as I just said. If you understand technology, a new disruptor in the market has the potential to replace you and is the future. Once you understand that, as the banks clearly do now, what are you going to do? Are you going to continue to fight them? Or are you going to want a piece of it? If you can't beat them, you join them, right? So that's what's happening with BlackRock as well right now. Anyway, 2 days later, on February 13th, announced appropriately enough in Paris, Apollo Global Management made their move. Apollo just signed a cooperation agreement with the Morpho Association. And under the deal, Apollo and its affiliates have the option to acquire up to 90 million Morpho tokens over the next 4 years through a mix of open market purchases, over-the-counter deals, and negotiated arrangements. Now, a lot of headlines just reported this as Apollo buys DeFi tokens. But that framing completely misses what's actually happening here. So let me explain it properly, or try to anyway. First off, who is Apollo? Apollo is the largest credit manager in the world. When big corporations need loans, when private equity deals need financing, when complex structured credit products get put together, Apollo is one of the firms at the center of it. They manage nearly $940 billion in assets, and their core business is credit. Secondly, to help us understand what's going on, who is Morpho? Morpho is a permissionless on-chain lending protocol. So it's more a what rather than who. Think of it as a decentralized version of the credit markets Apollo operates within. It currently has about 5.8 billion in total value locked, and it's the 6th largest DeFi platform by that metric. And here's the thing to understand about why Apollo is interested. Their deal with Morpho isn't just a token purchase. It's a cooperation agreement. Apollo wants to build on Morpho's infrastructure. They want to deploy their credit strategies on-chain using Morpho's lending rails. This is Apollo essentially saying the future of credit markets runs on blockchain infrastructure, and we want governance influence over the protocol we're going to build our business on top of. It makes sense, right? And this isn't theoretical either. It's already happening around Morpho. Bitwise launched a USDC yield vault on Morpho in January, offering 6% annual yields. And Coinbase integrated Morpho's infrastructure for its crypto-backed lending products, which currently supports 960 million in active loans and 1.7 billion in collateral. The token jumped 17.8% the day the Apollo deal was announced. But here's what I want you to focus on, not the price move. Focus on the signal. When the world's largest credit manager starts acquiring governance stakes in DeFi lending protocols, they're not just speculating, they're literally positioning themselves. And there's a huge difference. And then there's the third move, which might be the most structurally significant of all three, even if it got the least attention. On February 13th, Grayscale filed an S1 registration statement with the SEC to convert its existing Aave trust into a spot ETF. The proposed ticker is GAVE, which I happen to like a lot, and it would list on the NYSE Arca with Coinbase as their custodian and a 2.5% management fee. Bitwise has already filed a similar application back in December of 2025. So they've been working on this for a minute. If either of these get approved, and I want to be clear that it's still a big if, it would be the first US ETF ever to offer direct, regulated exposure to a DeFi governance token. That said, what is Aave and why does it matter? Well, Aave is the native token of Aave, okay, the single largest decentralized lending protocol in existence. And they're actually very interesting and very useful. I could do a whole video on just Aave. But the point is, they have over 27 billion in total value locked across multiple exchanges. It's essentially the DeFi equivalent of a major bank's lending division. But instead of a bank running it, it's a smart contract running it. And instead of shareholders controlling it, Aave token holders govern it. The way of the future. And here's the really important part, okay? The same week Grayscale filed, Aave Labs proposed a major token economics change, redirecting 100% of protocol revenue back to the Aave DAO treasury. And their goal is to better align the token with the protocol's actual financial performance. In other words, they're making Aave behave more like an equity stake in a real business. And now here is where I need to draw a really clear distinction, because this is the part that most people don't understand, and that's okay. I'll explain it for you. A Bitcoin ETF and an Aave ETF are fundamentally different products, like structurally, philosophically, completely different. When you buy a Bitcoin ETF, you're getting exposure to an asset that has one job: store value. Bitcoin doesn't have governance rights. It doesn't have a treasury. It doesn't generate protocol revenue. It just exists and appreciates or depreciates. However, when you buy an Aave ETF, if it gets approved, of course, you're getting exposure to governance rights over a live revenue-generating financial protocol. You're buying a stake in the decision-making process of a lending market that processes billions of dollars in transactions. Here's an analogy for you. A Bitcoin ETF is like buying a gold bar in a vault. An Aave ETF is like buying a seat on the board of a lending institution. Those are completely different things. Hopefully you can see it. So, will the SEC approve it? Well, that depends on how they handle questions around custody, liquidity. Aave's market cap is around 1.8 billion, which is much thinner than Bitcoin, and disclosure standards. So it's not guaranteed. But the fact that two major asset managers are racing to file tells you something about where institutional appetite, where their heads are at. So, okay, we've walked through three moves: BlackRock buying Uni, Apollo acquiring Morpho, and Grayscale filing for an Aave ETF. On the surface, they look like three separate stories, but they're not. They're the same story told three different ways by three different actors. And here's the through line. Traditional finance is not just buying exposure to crypto prices anymore. They're acquiring governance stakes in decentralized financial infrastructure. And that is a categorical different thing. When you buy Bitcoin through an ETF, you get price exposure, full stop. You don't get to vote on anything. You don't get influence on how the network evolves. You're just along for the ride or the crash, no pun intended. But when you hold Uni, Morpho, or Aave tokens, you have a voice in how those protocols operate. You vote on fee structures. You can vote on risk parameters. You can vote on which assets get integrated. And over time, the largest holders shape what these protocols become. And right now, the largest holders are starting to look a lot like Wall Street. Some people in the crypto community see this as a threat. The decentralization getting quietly replaced by the same institutional players, right? Who run traditional finance, the mob. I'm not saying they are the mob. I'm saying there may be mob vibes and behaviors. Anyway, the point is that's a legitimate concern and it deserves some airtime. But here's the systems level view. What we're watching is the bridge, okay, between traditional finance on the one side and decentralized finance being built in real time. And the bridge is being built from both ends simultaneously. They're reaching for each other. On the one side, you have DeFi protocols that have spent years building open, permissionless infrastructure that actually works with real users, real liquidity, and real revenue. On the other side, you have the largest asset managers in the world who are realizing that blockchain-based financial infrastructure is not going away, and that the smart move is to participate in governing it rather than fighting it. So we see the connective tissue between those two worlds is tokenized real-world assets. That market has grown from 1.2 billion in January of 2023 to over 25.5 billion by early this year, 2026 already. Stablecoin market cap is heading towards $1 trillion. The Genius Act goes into full implementation this summer, July 2026. So you see the pipes are being laid right now. So the big question is, if the largest credit manager on earth and the largest asset manager on earth are both acquiring governance stakes in DeFi protocols in the same week, what does that tell you about where they think the financial system is going? They're not doing this because they got excited watching a YouTube video, okay? They have armies of analysts, lawyers, and risk managers. They move slowly, methodically, and deliberately, and they both just moved in the same direction, in the same week. Coincidental? I think not. So let me bring it to a close. What does any of this mean practically for us? Here's what I say. This is not a signal to buy anything. I'm not telling you to go buy Uni or Morpho or Aave. Markets are volatile right now. Prices can and do go down. Past performance tells you nothing about what happens next. So please do your own research and keep your own finances in mind and never jeopardize your baseline. You should always secure your well-being and that of your families first. What this is, though, on the other hand, is simply a signal to understand something. The shift happening right now isn't about Bitcoin going up or down. It's about the architecture of the global financial system being quietly renegotiated and on-chain. And the people doing the negotiating aren't retail traders. They're the institutions that manage the money of pension funds, of sovereign wealth funds, and millions of ordinary people. Understanding why they're making the moves they're making, understanding the systems underneath, is what separates the people who get blindsided by these shifts from the people who see them coming. And that's what this channel is here for. If this kind of analysis is useful to you, and if you want to actually understand what's happening in these markets and not just react to prices, I'd invite you to subscribe to my channel because there is a lot more coming and lined up for us this year. And I'm going to be covering all of it for you and explaining it along the way as best as possible. So that's a wrap for today. I love you guys so much. Please like the video if it was educational. And let me know in the comments section what questions you have right now about the market, where we're headed. And I'd be so happy to consider them and bring them into future shows. I love you guys. Take care.